Hello, my name is Elliott. I'm editor of Personal Finance as well as The Energy Strategist. Today I want to talk a little bit about the state of the economy and generally the market. Again, as I've said many times, I don't think we're going to see a double dip for the U.S. economy either this year or next year in 2011. Really what we've seen since late April, early May is a softening in economic data, undeniable softening in the U.S. economic data. However, most of these indicators are still well above levels which would indicate a slip back into negative growth. For example, manufacturing PMI, which came out a couple weeks ago, actually came in much better than expected and still is well above that 50 level, which marks sort of the dividing point between expansion and contraction for the manufacturing sector of the U.S. economy. Yes, the employment picture isn't particularly strong, especially for a recovery from a recession as deep as we saw in 2008, 2009. We're not seeing the type of payrolls growth that we would typically expect after a recession of that depth. Normally, by this point in the cycle, we'd be expecting to see around 250 or 300,000 jobs added a month by the American economy. And as most investors are well aware, we've been averaging really under 100,000 for the past several months in a row. If that continues, we will actually see the unemployment rate start to creep higher again, probably back up over 10% here between now and the end of the year. However, none of this was really unexpected. I've been saying for well over a year and a half now that we would see a subpar recovery from the recession. One of the major reasons is that household debt is still very, very high. Households have debt to GDP ratio somewhere around 100%, and that's well above the norms. That's near record levels, really. And as a result, we're not seeing that normal push, that debt finance consumption push for the economy as we come out of this recession. All that said, outside the United States, the picture actually looks a little bit brighter. Just as U.S. economic data began to deteriorate in that sort of April, May, June period, we actually saw data from Europe pick up. A lot of people found that to be somewhat of a surprise, partly because back in May, a lot of the talk was that the European sovereign credit crisis, emanating from places like Greece and Portugal, Spain, would actually cause the EU economy to slip back into recession. We saw the euro sell off under $1.20. We saw bond yields on Greek government bonds, Spanish government bonds, even Italian government bonds really spike beyond normal levels. But none of that really came to pass. The EU credit markets have become much healthier again. The TED spread, which is a key indicator I watch very carefully, basically a measure of stress in the interbank credit markets, did spike in May, but quickly normalized, and we're actually near multi-year lows on that indicator right now, suggesting that corporate lending is very, very strong. Corporate lending, corporate new bond issues in July, August, and the first part of September has been very, very strong. So we're really not seeing much of a global credit crunch. The fears of that sort of a 2008 style credit freeze up have really, really receded. At the same time, we're seeing very strong numbers out of the core European economies. Germany is probably doing as well as it has in over a decade. The UK economy has had some mixed data, but the early read is that the budget proposed by the new UK government, which is a coalition government between the Conservative Party, which is sort of their center-right party, and the Liberal Democrats, traditionally not an ally of the Conservatives, actually, has actually been pretty effective. They've put together a pretty stringent budget, but that budget mainly relies on spending cuts for about 80% of the planned reduction in the deficit out over the next 4 or 5 years. So things are looking pretty good all across the Euroland and across the channel in the UK. Emerging markets, I really don't see any reason to believe that we're not going to see continued strong growth out of the emerging markets. Yes, the Chinese government has taken steps to slow the economy, but we're talking about a slowdown from sort of double-digit growth down to about 8-9%. I'm actually very bullish on India right now. It looks like Indian economic growth may actually exceed Chinese economic growth here over the next few years. And that's really good news. And it also means that it's a good time to look at a lot of the Indian companies that are actually listed on the NYSE. We have one of them in the personal finance growth portfolio. It's actually an Indian bank. It's actually been one of the best performing financials anywhere in the world. And while U.S. lenders are having trouble lending to consumers because of poor credit quality, lack of demand for borrowing, Indian consumers are under-leveraged and they're seeing tremendous loan growth well in excess of 20% annualized in India right now. So I think overall the idea that there's going to be a double dip for the global economy or even for the U.S. economy has been massively overplayed. The bears are the ones that's stealing the limelight on television. The word double dip appears just about every day in the financial press. But the reality is much brighter than that perception. And I think it's time to take a little bit of a contrarian bet. Any type of a sell-off we see here in the months of September, October, I would look at it as an opportunity to buy for a year-end rally in the stock market. I expect that the S&P will hit new recovery highs either at the end of this year or possibly early in 2011. The sectors I would focus on, look at sectors that are leveraged to strong global growth. That would include energy, basic materials, mining type companies. I would also look at some of the industrial cyclical plays, companies involved in, say, factory automation or anything involved in industrial type production. And I would look outside the U.S., companies like the Indian bank that I mentioned that are leveraged to strong rebound in growth in places like China and India. Thank you very much.